Preparing for a financial analyst at Centrica interview? You've reached Candy Mentor, and this video is for you. We'll walk through 25 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to work as a financial analyst at Centrica? Centrica appeals to me because it combines essential energy services with a clear transition toward lower carbon solutions. I would enjoy analyzing performance across customer, services, and energy-related activities, then translating results into practical recommendations. My strengths are structured modeling, attention to detail, and communicating financial issues clearly to non-finance stakeholders. I also value the company's focus on operational improvement and customer outcomes, where high-quality analysis can influence investment, pricing, cost control, and long-term resilience. While answering, connect your analytical skills to Centrica's energy, services, and customer-focused operations, demonstrate commercial awareness, interest in the energy transition, and motivation to support disciplined decisions with reliable financial insight. Question 2. What do you know about Centrica's business model? Centrica is an energy and services business best known for British Gas, serving residential and business customers while also providing installation, maintenance, and energy solutions. Its performance depends on customer numbers, consumption, pricing, retention, service productivity, energy procurement, and regulation. I would distinguish revenue growth from profitable growth because margins and cash conversion matter greatly in this sector. I would also monitor how investment in electrification and customer solutions supports future earnings. Make sure to cover Centrica's customer-facing energy activities, British Gas heritage, services and solutions, operational drivers, regulated and competitive characteristics, and how energy prices, volumes, customer retention, and productivity affect performance. Question 3. How would you assess Centrica's financial performance? I would begin with the income statement, separating revenue, margin, operating costs, and operating profit by business area. Then I would assess cash conversion, working capital, capital expenditure, leverage, and returns on investment. I would reconcile statutory results with management performance measures and explain unusual items rather than ignoring them. Finally, I would compare actuals with budget, prior year, and operational indicators such as customer retention, energy volumes, productivity, and service completion rates. In your answer, discuss revenue, gross margin, operating profit, cash flow, working capital, capital expenditure, customer metrics, adjusted versus statutory measures, and comparison against budget, prior periods, and relevant operational drivers. Question 4. Which key performance indicators would you monitor at Centrica? I would use a balanced scorecard. Financial measures would include revenue, gross margin, adjusted operating profit, operating cash flow, cash conversion, capital expenditure, and return on capital. Customer measures would include customer numbers, churn, retention, complaints, and satisfaction. Operational metrics could include engineer productivity, first-time fix rates, installation volumes, and cost per job. I would always connect a KPI to a value driver, because a rising customer count is not positive if margins or service quality deteriorate. Be sure to mention financial and operational KPIs, customer numbers, churn, retention, energy volumes, margin per customer, service productivity, complaints, adjusted operating profit, cash conversion, capital returns, and employee or safety measures. Question 5. How would changes in wholesale energy prices affect Centrica? The effect depends on procurement coverage, hedging, customer pricing, and regulation. A sharp wholesale price increase may initially pressure margins if retail prices adjust later, although hedges can reduce volatility. It can also increase collateral and working capital requirements. Conversely, lower prices may benefit customers but reduce revenue and alter margin timing. I would analyze the hedged position, tariff resets, contract structures, and cash impact rather than assuming price movements flow directly into profit. Focus on procurement timing, hedging, customer tariffs, regulatory rules, pass-through limitations, margin timing, working capital, collateral, and the distinction between short-term earnings effects and longer-term customer economics. Question 6. Explain the difference between EBITDA, operating profit, and operating cash flow. EBITDA measures earnings before interest, tax, depreciation, and amortization, making it useful for comparing operating performance before non-cash charges. Operating profit deducts depreciation and amortization, so it reflects the cost of using long-term assets. Operating cash flow starts from accounting profit and adjusts for non-cash items and working capital movements. EBITDA is therefore not cash flow. A business can report strong EBITDA while cash is absorbed by receivables, inventory, provisions, or other operating requirements. In your answer, define each measure, explain depreciation, amortization, working capital, provisions, and capital expenditure, and clarify why analysts use multiple measures rather than treating EBITDA as equivalent to cash generation. Question 7. How would you build a budget for a Centrica business unit? I would start with operational drivers rather than simply increasing last year's numbers. I would forecast customer volumes, churn, consumption, pricing, service activity, productivity, headcount, supplier costs, and investment requirements. Those assumptions would feed revenue, margin, operating expenses, cash flow, and capital expenditure. I would discuss assumptions with commercial and operational owners, challenge unsupported optimism, and create downside and upside cases. Once approved, I would track monthly variances and update the outlook when evidence changes. Cover driver-based forecasting, customer and volume assumptions, pricing, margin, headcount, supplier costs, capital expenditure, working capital, scenario analysis, stakeholder challenge, and monthly variance tracking after approval. Question 8. How would you investigate a forecast variance at Centrica? I would first quantify the variance and confirm that the underlying data and accounting period are correct. Next, I would bridge the difference into volume, price, mix, productivity, timing, foreign exchange, and one-off effects. I would speak with the responsible business owner to test the operational explanation against evidence. Finally, I would distinguish a temporary timing issue from a structural problem, update the forecast where necessary, and recommend a specific action, owner, and monitoring metric. Make sure to explain how you quantify the variance, separate volume, price, mix, timing, and one-off effects, validate source data, engage owners, identify root causes, and recommend corrective actions with a revised forecast. Question 9. What is working capital, and why is it important for an energy services business? Working capital represents operating assets and liabilities that absorb or release cash, commonly including receivables, payables, inventory, accruals, and customer balances. At Centrica, billing cycles, collections, supplier terms, energy procurement, and collateral can create significant timing effects. I would monitor days sales outstanding, overdue debt, payable days, and movements against forecast. Improving cash collection helps liquidity, but I would avoid damaging customer relationships or supplier reliability through overly aggressive practices. Discuss receivables, payables, inventory, accruals, customer deposits, billing timing, supplier terms, collateral, cash conversion, and the tension between improving liquidity and preserving customer service and supplier relationships. Question 10. How would you evaluate a proposed investment in home energy services or electrification? I would model incremental customers, adoption rates, pricing, contribution margin, installation volumes, staffing, technology costs, capital expenditure, and working capital. I would calculate payback, NPV, and IRR using a suitable discount rate, then stress test adoption, costs, delays, and customer retention. I would also assess strategic benefits, such as stronger relationships and cross-selling, while keeping them separate from directly measurable cash flows. The recommendation should show both financial returns and execution risks. Be sure to mention incremental revenue, contribution margin, customer adoption, installation capacity, capital expenditure, operating costs, payback, NPV, IRR, risks, scenarios, and strategic benefits that may not appear immediately in the base case. Question 11. What is the difference between statutory and adjusted performance measures? Statutory measures follow applicable accounting standards and include all recognized income, expenses, impairments, and gains or losses. Adjusted measures exclude items management believes obscure underlying performance, such as significant restructuring or one-off disposals. They can improve comparability, but judgment is involved, so I would review the reconciliation and ask whether supposedly exceptional costs recur. In analysis, I would use adjusted results to understand trends while retaining statutory figures for completeness, cash implications, and accountability. Focus on international financial reporting standards-based statutory reporting, management adjustments, exceptional or non-recurring items, transparency, reconciliation, comparability, and why analysts should not automatically treat adjusted profit as the only meaningful performance measure. Question 12. How would you explain a financial result to a non-finance manager? I would lead with the conclusion, such as, profit is £5 million below plan, mainly because service volumes were lower and contractor costs increased. I would then show a simple bridge from budget to actual, separating controllable and uncontrollable factors. I would avoid accounting jargon, confirm the operational interpretation with the manager, and finish with actions, owners, and timing. If the audience needs detail, I would provide supporting schedules rather than overwhelming them in the first explanation. In your answer, emphasize plain language, headline conclusion first, operational drivers, quantified impact, visual bridges, relevant actions, assumptions, and adapting the level of detail to the stakeholder's role. Question 13. What accounting issues could arise from customer contracts at Centrica? I would consider when Centrica satisfies each performance obligation and whether energy supply, maintenance, installation, or other services are distinct. Revenue should be recognized as control transfers, with estimates for variable consideration, refunds, incentives, or contract modifications. Energy delivered may be recognized based on consumption estimates and later reconciled, while service revenue may depend on completed work or an overtime obligation. I would document assumptions carefully because billing timing does not automatically determine accounting revenue. Discuss revenue recognition, performance obligations, timing of energy delivery and service work, contract modifications, variable consideration, customer incentives, refunds, and the importance of matching recognized revenue to fulfilled obligations. Question 14. How would you analyze an impairment risk for a business unit? I would first identify indicators such as sustained underperformance, customer losses, regulatory changes, higher funding costs, or a falling market valuation. I would determine the relevant cash-generating unit and estimate recoverable amount using value in use or fair value less costs of disposal. Key assumptions would include forecast cash flows, terminal growth, margins, and discount rates. I would run sensitivities, challenge optimistic assumptions, and clearly explain headroom, downside triggers, and management actions. Cover indicators of impairment, cash-generating units, value in use, fair value less costs of disposal, forecast cash flows, discount rates, terminal assumptions, sensitivity analysis, and disclosure or governance requirements. Question 15. How would rising interest rates affect Centrica's financial analysis? Higher rates can increase interest expense on floating rate debt and raise refinancing costs when borrowings mature. They also increase discount rates, reducing the present value of projects, impairing valuation headroom, and potentially affecting pension measurements. Customer affordability may weaken, influencing arrears or demand for discretionary services. I would review debt maturity, hedging, liquidity, covenant headroom, project returns, and sensitivities rather than focusing only on the income statement interest charge. Make sure to cover borrowing costs, refinancing, discount rates, pension obligations, valuation, customer affordability, investment hurdles, liquidity, and the difference between direct earnings effects and broader demand or risk effects. Question 16. What financial risks are particularly relevant to an energy company? Relevant risks include wholesale commodity volatility, customer credit and arrears, liquidity and collateral requirements, regulatory intervention, operational disruption, cyber threats, and the pace of the low-carbon transition. Weather can affect demand and operational outcomes, while poor customer conduct can create financial and reputational costs. I would quantify exposures where possible, monitor limits and early warning indicators, test severe scenarios, and confirm that mitigation actions, ownership, and escalation routes are clearly documented. Discuss commodity price, credit, liquidity, regulatory, operational, cyber, weather, conduct, and transition risks, along with hedging, controls, scenario analysis, risk limits, and escalation procedures. Question 17. How would you test the reliability of data in a management report? I would identify the report's critical fields and reconcile totals to the general ledger or approved operational systems. I would test completeness, accuracy, cutoff, duplicates, unusual movements, and consistency with prior periods. Key formulas would be reviewed independently, and I would preserve an audit trail showing source data, transformations, and approvals. I would also perform reasonableness checks against customer volumes, staffing, and cash results. Any unresolved issue would be escalated before publication. Be sure to mention source system reconciliation, completeness, accuracy, period cutoff, duplicate checks, automated controls, audit trails, variance tests, ownership, and independent reasonableness checks before distributing the report. Question 18. Tell me about a time you found an error in a financial analysis. In a monthly forecast, I noticed that service revenue rose sharply while completed jobs were flat. I traced the movement to a spreadsheet formula that included an outdated regional range, overstating revenue by approximately 3%. I corrected the model, informed my manager before distribution, and reran the forecast and variance commentary. I then added range checks, locked formula cells, and introduced a second-person review for key outputs. The experience reinforced that analytical judgment must be supported by disciplined controls. In your answer, use a concise star. Question 19. How would you prioritize competing deadlines during month-end? I would list deliverables by deadline, materiality, dependency, and stakeholder impact. I would complete items feeding the close or board reporting first, clarify requirements early, and agree realistic sequencing with my manager. I would use a checklist for recurring controls, protect time for review, and communicate immediately if a conflict threatens quality. I would not solve pressure by skipping validation. Instead, I would simplify low-value analysis, reuse reliable templates, and focus effort on decision-critical outputs. Focus on materiality, reporting dependencies, fixed close deadlines, stakeholder impact, quality risks, early communication, task sequencing, delegation where possible, and maintaining controls instead of sacrificing accuracy under pressure. Question 20. How would you forecast customer churn at Centrica? I would begin with historical churn by customer segment, tenure, product, geography, payment method, and service experience. I would examine pricing changes, complaints, outages, arrears, seasonality, and competitor activity as possible drivers. A cohort or statistical model could produce a baseline, but I would validate it against recent behavior and management insight. Finally, I would translate churn into customer counts, revenue, margin, acquisition costs, and cash flow, then stress test retention assumptions. Discuss historical cohorts, tenure, tariff and pricing changes, service experience, complaints, payment behavior, seasonality, customer segments, external benchmarks, model validation, and translating churn into revenue and margin consequences. Question 21. What does good variance analysis look like in an energy services business? Good variance analysis explains what changed, why it changed, whether it is temporary, and what happens next. For example, lower profit might reflect fewer installations, weaker margin per job, and delayed billing rather than one generic cost issue. I would separate price, volume, mix, productivity, timing, and one-offs, quantify each effect, and identify controllable actions. The analysis should conclude with an updated forecast and clear ownership, not merely document historical results. Cover a clear budget to actual bridge, operational drivers, price volume mix analysis, timing and one-offs, controllability, materiality, root cause, forward implications, and actionable recommendations rather than descriptive commentary alone. Question 22. How would you assess whether a cost reduction program is successful? I would establish an agreed baseline and define whether the target is gross or net savings. Then I would track implemented actions, run rate benefits, one-time costs, inflation, volume changes, and any cost shifting between departments. I would reconcile claimed savings to actual ledger results and cash flow, while monitoring customer satisfaction, safety, complaints, and service levels. A program is successful only when benefits are recurring, measurable, and achieved without creating larger downstream costs or operational damage. Make sure to distinguish gross savings from net recurring savings, establish a baseline, separate volume and inflation effects, track implementation costs, monitor service quality, and verify benefits through the income statement and cash flow. Question 23. How would you value a long-term energy or services project? I would forecast incremental free cash flow from revenue, margins, operating costs, taxes, working capital, maintenance investment, and any upfront capital expenditure. I would discount those flows using a rate consistent with the project's risk and calculate NPV, IRR, and payback. I would test demand, pricing, cost inflation, delays, useful life, and terminal assumptions. I would also consider strategic and regulatory factors, but I would keep qualitative benefits distinct from the core financial case. Discuss forecast free cash flows, initial investment, operating assumptions, taxes, working capital, terminal value, discount rate, NPV, IRR, scenario analysis, and risks around regulation, technology, demand, and execution. Question 24. What Excel or analytical tools would you use in this role? I am comfortable using Excel for driver-based models, including XLOOKUP, SUMIFs, index match, pivots, scenario switches, sensitivity tables, and error checks. I would use Power Query or SQL to clean and combine larger datasets, then present insights through concise dashboards or Power BI. I document assumptions, separate inputs from calculations, and build reconciliations into models. Automation is valuable, but I still review outputs against business logic and source data before relying on them. Highlight advanced Excel, Power Query, pivot tables, lookup and aggregation formulas, scenario modeling, data visualization, SQL or BI tools, version control, documentation, and knowing when automation improves reliability. Question 25. What would you do if a senior stakeholder challenged your analysis? I would first listen carefully and clarify whether the concern relates to data, assumptions, methodology, or interpretation. I would revisit the source information, reproduce the calculation, and test alternative scenarios rather than becoming defensive. If I found an error, I would correct it promptly and explain the change. If the analysis remained sound, I would present the evidence, sensitivities, and limitations respectfully. My aim is not to win an argument, it is to reach the most reliable decision. In your answer, emphasize listening, clarifying the disagreement, checking assumptions and evidence, separating facts from judgment, remaining respectful, revising when warranted, and standing behind a well-supported conclusion when necessary. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.